Well, congratulations. You have reached the end of Accounting 2301. This is the last recording that I will be sharing with you about 2301. It covers chapters 15 and 16, but I'm not going to spend a lot of time on chapter 15, partnership accounting. Why? Because it's a different type of organizational entity, and just like corporation accounting, when value is created, it must be placed into different types of equity value accounts. There's nothing too unusual about partnership value accounts per se, except for the fact that they reflect the value that is allocated to different partners of the organization, and to the extent that corporations have shareholders or stockholders and partnerships have partners, you do have some differences in terminology. I would, however, like to spend a significant amount of time on chapter 16. That is a very highly quantitative chapter on the statement of cash flows. And in order to do that, let me ask you to turn to figure 16.2. That is 16.2. It's a balance sheet for a company. As you see down the left-hand column, like any balance sheet, we have our assets, our liabilities, and then equity value. They list to the right of those titles the balance sheets for the years 2017 and 2018, but please be careful. The more recent year, 2018, is the column on the left. The older year, the prior year, 2017, is the column on the right. And so when you look at the final column on the far right, which is change from one year to the other, please, again, do keep in mind that the change is from 2017 to 2018, not the other way around. In addition, please keep in mind that when we talk about different numbers changing value, there are 4 subtotal and total numbers or rows. Total assets is a total. Total liabilities and total equity, those are subtotals. Total liabilities and equity, that is a total. And so when we start to talk about taking the changes from that third and final numerical column of this balance sheet and working with them, we're not referring to the subtotal or the total numerical changes, but rather we're talking about working with changes to the asset, liability, and equity line items or accounts. So what are we doing with this? Well, let's start with assets. As you can see, what we've done is compute for each asset the extent to which it increased or decreased over the course of the year. In most situations, if an asset has increased in value, it has had a negative effect on cash. Why? Well, look at plant assets. It might be buildings, equipment, things of that nature. It increased by $40,000 this year. Well, that's great. But where did the money come from to buy that extra $40,000 of plant assets? Well, it probably came from cash. And as a result, an increase in plant assets is equivalent to a decrease in cash for purposes of creating the statement of cash flows. Now let's look at accounts receivable. Accounts receivable decreased from $26,000 to $21,500 this year. What is that? What is the impact of that decrease on cash? Well, one plausible explanation for a decrease in accounts receivable is that your customers are paying you more quickly, and that's good for cash. Your cash, that is. Let's look at inventory. Inventory increased from $45,500 to $48,000 this year. Is that good or bad for your cash account? Well, if inventory is increasing, where did you get the money to buy the inventory? You must have spent cash, and therefore an increase in inventory is going to have a declining value, a negative value on cash. Liabilities, it's different. Let's take a look at accounts payable. Accounts payable went down from $19,000 to $17,200 over the course of the last year. Well, if a liability goes down, one plausible explanation is you're paying it off. You owe the money, you're paying the money. Well, it's a good idea to pay your debts, but if you're using your cash to pay off your debt, then that must mean that you have a declining balance in cash. If liabilities decline, it has a negative impact on cash. Let's take a look at notes payable. Notes payable increased by $10,000 this year. In other words, we went out and we borrowed an extra $10,000, bringing in more cash. Increase in notes payable is analogous with, is caused by, or creates a $10,000, in this case, increase in cash. We're seeing a pattern here, but the pattern is different for assets than for liabilities. For assets, an increasing balance is negative for cash. A decreasing balance in an asset is generally positive for cash in terms of its cash effect. For liabilities, an increasing balance in a liability is good for cash. It's analogous with, it creates an increasing cash balance. A decreasing liability is analogous with a decreasing cash balance. What about equity value? Well, in this case, common stock went up by $45,000 last year. That means that a new investor looked at our company and said, "Nice company you have there. Here's $45,000 for you in cash. Please let me buy into an ownership interest." And you took the money. Well then, as common stock increases, that increase is analogous with an increase in cash. Were an equity value item to decrease, it would be analogous with a decrease in cash. The reason why it's so important to look at the change in your balance sheet account over the course of the year, and that's exactly what we're looking at in figure 16.2 in that column on the far right. The reason why it's so important to create that column is that you can look at the numbers in that column, not the subtotals, not the totals, but the other numbers. You can look at those numbers and say, each of those numbers explains why cash went up or down by a certain amount. You just have to keep in mind that the change in asset balances creates an opposite directional impact on cash. And that's not true of liabilities and equity. Now, if you'd like to see evidence of this, you can compare figure 16.2 with the statement of cash flows in figure 16.4. And the first thing that you should notice, hopefully the primary thing to notice, is that by and large, the numbers in the fourth column, well, it's the third numerical column, fourth column overall, the numbers in that change column in figure 16.2 are used to create 16.4. What do I mean by that? Well, let's go to 16.2. Remember how we said that notes payable increased by $10,000? Well, now let's go down to 16.4. If we look at the first line of the cash flow from financing activities section, there's the $10,000, payment of notes payable. Would you like to see another example? Well, let's look at 16.2, the common stock line. Common stock went up by $45,000 over the course of this year. Is that number highlighted in the cash flow statement, figure 16.4? Sure it is. In the same cash flow from financing activities section, right below the $10,000 note payable number that we just discussed, there is the $45,000 cash inflow issuance of common stock to a new stockholder. What about assets? Let's go back to 16.2. We had said that accounts receivable decreased by $4,500 because our customers were paying us what they owe us more quickly, and that should have a beneficial impact on cash. Does that $4,500 number appear in the cash flow statement in figure 16.4? Absolutely. Look near the top of figure 16.4. In the operating activities section, the very third line, accounts receivable, $4,500. And just to give you one more example, we have not yet seen a number in the investing activities section of figure 16.4. So just to make sure that we cover all of those different sections of the cash flow statement, let's look for a number that will appear in the investing activity section. If you go back to 16.2 and look at the asset, plant assets, if you recall, we had mentioned that plant assets increased by $40,000 over the course of the year. most likely because we bought some new equipment, and that because we paid cash for that new equipment, that new asset, there should have been a $40,000 decrease in cash to buy new plant assets. Well, let's look at figure 16.4. Let's look at the investing activities section. It's the smallest of them all, in the very middle of 16.4. The second line, cost of new plant assets, or more specifically, equipment purchased, negative $40,000. In other words, for the most part, the numbers in the fourth column of 16.2 are used to populate or complete the schedule in 14.4. And even when there seems to be a discrepancy, you should be able to reconcile it. Let me give you one example of that. If you look at 16.2, retained earnings increased by $3,900. Can you find $3,900 anywhere in figure 16.4? Well, at first glance, it does not appear that way. But if you look at figure 16.4, you can find two numbers, which when combined gives you 3,900. The very first number at the top of figure 16.4, 4,340. There's also a number in financing activities section, payment of dividends, $440. Well, if you take the $4,340 number in figure 16.4 and combine it with the negative 440 number in figure 16.4, you do indeed get the $3,900 change of retained earnings number that you are looking for that appears in figure 16.2. The bottom line is, when you are creating a cash flow statement, by and large, you are using the balance sheet, such as the one that you see in figure 16.2, to help you calculate the numbers that you then use to create your statement of cash flows in 16.4. In one or two isolated incidents, you might take a number and split it in half, or divide it into multiple pieces, or take a couple of numbers from table 16.2 and combine them for 16.4. By and large, though, you are using figure 16.2 to create figure 16.4. And with that, I will say congratulations, and I do hope that you continue to find success as you wrap up the class and in your career in the field of accounting.